that one-time initial $1,000 investment would be worth 492,000, a 492x. And people love Chris Mayer's book on 100 baggers, but this investor didn't analyze a company. He didn't look at an individual stock or understand a balance sheet or anything. He just bought the overall index, and he's up nearly 500x over 64 years. So one of the wonderful things that we do, Kyle, as hosts here at TIP, is help people learn how to invest, or at least hopefully help people learn how to invest. And investing is something that we're both very passionate about. And I think we both generally think it's really important to know, understand, and know what sort of role it plays in our lives. And they say that there are no free lunches in life, but when I first learned about investing when I was around 18 years old, it sure felt like one of the closest things to a free lunch I've ever found. And the reason for that really is because of the power of compounding and the freedom that investing can give us. And really, the premise of this episode is to share some of the things that Kyle and I have learned over the years and why we're so passionate about this topic of investing. And I wanted to start by sharing a story of a family member that passed away a few years ago. So my grandfather, he passed away when I was very young in the 1990s, so I really never knew him. And then it was some years later, my grandmother, she remarried to a farmer from the area where she lived and where I grew up. And for those in the audience who have read the very popular book, The Millionaire Next Door, this guy was really the classic example of the millionaires they studied in this book. He was very frugal. He worked for much of his life, and he really understood the power of compounding very early, as he was very interested in investing. And I think for a lot of people that knew him, they would have never guessed, he became as wealthy as he did. I certainly don't know the details, but I know he certainly did well for himself. And I wanted to talk through some of the things he did throughout his life and some of the lessons I picked up from getting to know him throughout my own life too. So I think of the investments he had really in these three pillars. So naturally, he was born on a farm and he just went into farming. So really, farmers, I sort of think of it as entrepreneurs at heart. So throughout his life, he grew his operations on his farm. He acquired more land and, worked with various other people in his family. But like a lot of other people out there in our world today, he didn't, just make money from his work or make money from the farm and go out and buy nice vehicles or buy a nice house because he did so well throughout his entrepreneurial pursuits. He started investing that money elsewhere. And this is where I wanted to tie in the second pillar of his investments, which was his private businesses. And him and some other people that were active in the community, they started a local bank in a small town that he lived in. And he wasn't active in the day-to-day operations of this bank. He oversaw what was happening. I'm sure he helped getting people onboarded, hiring people. And he had an equity stake in the bank. So he was one of 9 people that helped get it going back in 1984. And then over the years, the bank's just had substantial growth and it's opened new branches. And last year, I actually attended their annual meeting, which was quite interesting in itself. And, it's the type of situation where you see the managers, they're people you can trust, and you see, their type of capital allocation decisions. You see their earnings just march up year after year at around that 10% mark. And they produce substantial free cash flow for a community bank. It was very conservatively run. And then if those two pillars weren't enough, the third pillar was that he was also very, very interested in the stock market. And I remember throughout my college years when I sort of started to gain an interest in it, about every time I saw him, he always had some story of a stock he owned or how his portfolio was doing at the time. And I believe he bought into Berkshire around the great financial crisis. He was a huge fan of Buffett. And I believe he also cloned Buffett's purchase of Apple. And then he passed away in 2020, and it was time to distribute his assets, and he ended up donating a lot of what he accumulated over the years and just donated to charities locally. And that also reminded me of Buffett, just like, living this very frugal lifestyle and ending up just giving a lot of it all back to society. And one thing that really stuck out to me and where I'm going with the story is just how well he did financially and how just like starstruck some people were when they saw like kind of his end result. And again, I don't know the exact numbers, and it's not like he was a billionaire like a lot of the people we talk about on the show. But when someone who doesn't understand compounding sees the results of it, you can just see how in awe they are. And, you can just see in their mind that they're thinking, how is this possible? Like, did he get lucky? Like, what am I missing? Like, is essentially what they're asking themselves. Like, it's like, why can't I, be in that sort of position? And then, it was just such a great case study for me in my actual life of what compounding can do for us. We always hear the story of Buffett, and he got 99% of his wealth after he was 50 or 60. And he's one of the richest people on the planet because he's fully utilized compounding. But to see that in your actual life, I think just really made a big impact on me. And what's also very interesting and sort of funny about the story is I sort of saw him like as the local Buffett. He lived this frugal lifestyle. He gave a lot of his wealth away. And like I mentioned, the millionaire next door, he didn't try and flash his wealth. He lived by an inner scorecard rather than an outer scorecard. And he really could care less what other people thought about him. And just had a lot of these Midwestern values that I think Buffett sort of embodies. So yeah, that's a story I really wanted to share. And one of the things I've picked up over the years with regards to compounding.
Yeah, and I can relate somewhat to this story because my grandfather was similar in some ways. He passed away in his 90s, so he was around for a long time, but he was a very, very avid saver for most of his life. And not only did he save, but like you said, he compounded it by investing it and putting money into the compounding engine. And so he never really discussed investing much with me because unfortunately he passed away when I was still a teenager. But from talking with my mom, I got a chance to learn about some of the different investments that he made. So I know he had boring government bonds, which, paid just a nice little coupon, but that worked for him. He was a child of the Depression era and obviously, was very risk averse. I know that he was very risk averse. So bonds made a lot of sense for him. And then I know he also owns some Canadian blue chip stocks, things like banks, railroads that paid a nice secure dividend and had very, very strong moats and most likely weren't going to be going anywhere. So the thing that really stood out to me about my grandfather was that he helped use his savings to provide me with a great life when he was still around, not even after he passed away. So, while I was in elementary school and high school, he paid for tons of things like my hockey equipment, back to school shopping, clothes, shoes, tons of activities. So he managed to enhance my life with all the savings that he did from his working days and his frugality, which I'll get into as well. So in regards to compounding, I never, ever got a chance to talk to him about it. But my grandfather's pretty smart. I wouldn't be surprised if he understood it to some degree. But he definitely compounded his money over a long period of time and it grew to a nice little chunk. And same thing, he gave away a lot of it while he was alive as well. So a funny story just to illustrate my grandfather's frugality was in the beer he bought. I remember going to a store with him when I was in my teens and he asked me to go grab some beer. This was before I started drinking, and he gave me money and said, just go buy whatever the cheapest one is. And I think it was like Old Milwaukee or something. And I didn't really give it much time at the thought because I didn't drink beer. But, he told me, I don't even know why it came up, but he told me, he's like, all beer tastes the same. Just buy the one that's cheaper. It does the exact same thing. And I was like, yeah, you know what? That makes some sense. So this is a lesson that I still really continue to live by. It to some degree, obviously I enjoy some things that are quality, but, being frugal in things where quality maybe isn't as important to you is a way to increase your savings rate. And that's something that he really instilled on me and that I still use to this day.
Yeah, that's a really great point. I had Ramit Sethi. He always made the point in his book that you should cut ruthlessly in things that aren't as important to you, but then spend lavishly in the things that are very important to you. So it's like, finding those things that you find value in, and obviously you and I highly value compounding our investments, and we want to make sure we're allocating some chunk of our income towards that. And compounding, it's really one of those things that amazes you when you first discover it. You pull up the compound interest calculator that everyone checks out the first time, and you're just in awe of like the power it holds. And then you wonder why in the world you weren't taught this at an earlier age. And another thing I've noticed is that you really either get it or you don't. Just the other day, I was playing basketball and I was meeting some guys that, just kind of telling us a little bit about ourselves. And I mentioned to them, what I do, what I'm invested in. And right away, they just want to talk about like Dogecoin and all these other things. And it's like, yeah, if they were shown the compound interest calculator, I just don't see it registering in the way that it would for you or me or all the people we talk with in the audience. And there's just something in terms of a personality trait of, the way we're wired, and to be able to see that power and see the value that it can add to our lives. And I had mentioned that, many people that were surrounded by him were in awe of the gentleman I talked about. And I think the reason for this partially is that, we're not wired to think in these exponential sort of frameworks. We're pretty much wired to think linearly. And I don't want to bore people with, these compound interest numbers, but I do want to share an example of compounding using the story I had sort of as a template. As much as we cover investing on the show, it's not very often we talk about, this true long-term power of, why in the world we're so passionate about this. So that family member I talked about, he finished his active duty work. I went back and looked at his history. He finished his active duty work for the U.S. Army in 1956, and he was 26 years old at the time. So just running the math, he was around 90 when he passed away in 2020. And let's just say he managed to get $1,000 when he was 26 years old. I'm sure many people would say that's ridiculous. There's no way you could save that amount, but this is just for illustrations purposes, and it's just a one-time investment. It's something he could have certainly built up over time. So if he started with $1,000 in 1956, that's equivalent, based on just a CPI calculator, equivalent to around $11,400 today. And let's say he invested that in the S&P 500 and reinvested all the dividends over time. So this is what that journey would look like from 1956 through 2020 when he passed away. By 1970, that $1,000 investment would be worth $3,200. It's not bad. It's over 14 years, you've tripled your money. I mean, not life-changing money, but seriously, not bad returns. So fast forward to 1980, he'd be up to $5,900, so almost a 6x in 24 years. 1990, it'd be over $27,000. And the nominal return at this point would be 10.2%. That's over 34 years. Fast forward to 2000, the 90s was quite a great decade for stocks. The 27,000 increased now to 147,000. So now from 1956 through 2000, 44 years, you're up 147x, and that's a 12% average annual return. And then due to that really good decade in the 90s, we had a slower decade in the 2000s. So it actually shrunk. It shrunk to 138,000 because the stock market was down over that 10-year time period. And then, as stocks do, they rose again the following decade. So the year he passed away in 2020, that one-time initial $1,000 investment would be worth $492,000, a 492x, like just mind-blowing numbers. And people love Chris Mayer's book on 100 baggers, but this investor didn't analyze a company. He didn't, look at an individual stock or understand a balance sheet or anything. He just bought the overall index, and he's up nearly 500x over 64 years. And just to share the average return on that, it's 10.2%. And, we often quote an average return of 8 to 10% in the US markets, at least. And it's no wonder that Buffett and Munger, they've preached for years that the key to success in life is delayed gratification. And in reflecting on this example, I wanted to share a few points that I think worth highlighting here before I throw it over to you, Kyle. So the first is that we have to consider the impact of inflation when looking at such long time periods. Just due to math, stocks are likely to go up over time just because the currency is losing value. So it should be no surprise that stocks continue to hit new highs, eventually at least, over 10, 15, 20-year time periods. And then the first 14 years, I had mentioned it went from 1,000 to 3,200. So in the first 14 years, he gained $2,200 on his investment. In the last 10 years, he gained $354,000. And I think there's just no way you can shortcut this process. You have to put in the time, put in the patience. You have to kind of wait through that grind of the initial slow early years to get those massive gains down the road. And Morgan Housel, in his book, Psychology of Money, he highlights that much of the power of compounding comes from simply giving it enough time to work. And for most people, investing success is not going to be from achieving above average or high returns, but it's just simply staying in the game for long periods of time. And we regard Buffett as the greatest investor of all time. And really, obviously, he did generate high returns, but the most important part of the equation in him becoming the best and the wealthiest and known as the GOAT is he compounded his money much longer than the vast majority of other people. And then the third point here is in 1956, the S&P was trading around $45, and in 2020, it was around $3,200. So while the S&P 500 was up 71x over that period, his investment was up 492x. So it's like, okay, what's happening here? The reason he got such a much higher return than the index itself, what he was invested in, is because he reinvested dividends. And that's something that people sometimes ignore or exclude from this type of analysis. And, it's common practice to just, nowadays, especially just with our whatever account you use, just to automatically reinvest dividends. You don't even have to do it yourself. You can just make it simply just click and automate it. So just by making that one decision of reinvesting dividends, this increased his ending amount that he ended up with by nearly 7x. And again, it just points to, people think that'll just be a linear change adding dividends, like, oh, he gets a slightly higher return. But, again, this is an exponential problem, and it really helps illustrate the power of continuous contributions to your accounts, reinvesting dividends, and obviously sticking with the long run.
Yeah, those are great examples, Clay. And like you said, the concept of compounding just really, really is not intuitive. A great question that I believe I read from Thinking Fast and Slow by Kahneman and Tversky that I've read that I've thought about a lot, and it illustrates this really well. So in a lake, there's a patch of lily pads. Every day, the patch doubles in size. If it takes 48 days to cover the entire lake, how long does it take for the patch to cover half of the lake? So intuitively, I remember the first time I heard this, my brain just wanted to half 48 and say 24 is my answer. And it's completely wrong. So the simple way to look at this equation is basically, if the patch is full on day 48, then the day earlier, 47, it's half full. That's it. So if you looked at that lake, it takes 47 days or 98% of the time for the lake to fill up halfway. Then it takes 1 day or 2% of the time for the lake to fill up with lilies entirely. So that just kind of goes to what Clay was talking about with, you have to wait a long period. And the longer you wait at the end, that's when compounding really, really kicks in. And that's when you can really grow your wealth. So Albert Einstein famously said, quote, "Compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it." Unquote. If you don't want to unlock the ability to compound money, you must try and understand how it works. And I don't know about you, but I never learned how compound interest works in school. But I think one of the most underrated parts about compounding interest that Einstein alludes to in that quote is that if you don't understand it, you end up paying it. So there's a story about a king, a chessboard, and the sage. And, I'm sure you've heard there's many different ways of saying it, but essentially there was a king and he liked playing chess. So he would go around and challenge people to play games of chess. So one day there was a traveling sage and the king challenged him to a game of chess. So the sage, having played chess all his life, was obviously good and probably knew he could beat the king. But the king offered him a reward for beating him. So the sage said, okay, well, you know what? Here's what I want. I want you to put a single grain of rice on the first chess square and double it on every consecutive square thereafter. The king, didn't understand compounding. So he said, that's nothing, easy. Sure, let's do it. So they played the game. The sage wins. And being a man of the word, the king gets a bag of rice and starts putting 1 grain on, 2 grains on, 4 grains on, 8 grains on, and keeps going, doubling on each subsequent square. But of course, the sage, understanding compounding, knew that there's no way that the king had even close to enough rice to pay him. So after the king got to the 20th square of the chessboard, he would have had to put about 1 million grains of rice on. By the 40th square, that would increase to 1 billion grains of rice. And by the 64th square, that would have been 18 quintillion, which is 18 followed by 18 zeros, grains of rice, which is equal to about 210 billion tons. This story illustrates just how much of a benefit understanding compounding is versus how much of a detriment ignoring it really is for you.
Yeah, those are both also wonderful examples. And one of my favorite quotes on compounding is one from Gautam Bade, one he shared in his book, The Joys of Compounding, is from Anshul Kaur. Probably butchering that name. He writes, in the initial years, compounding tests your patience. In the later years, your bewilderment. And I just absolutely love that quote. And without talking too much about compounding and all the wealth and money it can give us down the line, some people might be listening and thinking that we're totally obsessed with money. And that isn't necessarily what I want to communicate with this, or it's not, because it's not necessarily the case. And I know it isn't for me, and I can only speak for myself, and I'm sure it is for you, Kyle. I really see money as a tool that enables us to help us live the lives we want and do the things we want to do. And really, at the end of the day, money can give us the freedom to live the type of life that we truly want to live. And Munger has long talked about how he didn't just want to get rich. He wanted to have enough money to have the freedom to live life on his own terms. And Kyle, it reminds me of the presentation that you did for our mastermind community, where you shared your portfolio results for 2023. And during that presentation, one thing that stuck out to me is that you have the financial goal of becoming financially independent. So talk about what this means to you and why you ended up setting that as your goal.
Yeah. So to me, financial independence is quite simple. I can't remember exactly who said it, but it's basically to do whatever I want with whoever I want, whenever I want. And so to me, like you said, obviously money is important, but it's more of an unlock to unlock these 3 characteristics that I hope to achieve one day. So to me, being able to manage my own money while doing nothing else would mean financial independence. And I know some people think that if you have to do any type of work, they're still saying that I would be working by managing my own money. And in their defense, I guess if they use that as their definition, then I wouldn't be financially independent. But to me, I love investing so much. So if I could just manage my own money and live off of that, I would basically be, doing something I really love to do and not having to do anything else. I could set my own schedule. Like I said, do whatever I want, whenever I want, with whoever I want. So to me, that would be financial freedom. And, essentially, I would have to build a portfolio up to cover all my family's expenses for a long period of time. And then with the effects of compounding, that just grows, which is great. And then I can do whatever I want with that money. And then just kind of getting into, the nitty gritty of how that works, your income and your savings rate have a lot to do with how quickly you can reach financial independence. But it's important to define in whatever light makes most sense to you. Another interesting point about finances is just the lifestyle you choose. There are tons and tons of people, like Clay mentioned, the millionaire next door. They have tons of examples of people there just, working blue collar jobs who retire with a lot of money. And then you got people making 6, 7+ figures, and you hear about them going bankrupt after their career is over and they have nothing. So, no matter how much money you're making, it's all about decisions in life and figuring out what you want to allocate your money towards. You're either allocating it towards things that are, shiny toys right now, which a lot of people do. And if you do that, perfectly fine. I'm not judging you. But me personally, I like to allocate a certain percentage of it basically to buying my freedom in the future. So that's kind of how I look at it. And obviously that means I do have to sacrifice some splurges that I could make if I didn't save money, but I'm okay with that. So anyways, I just wanted to bring that up because it's why people with, lower paying jobs can retire with, these ungodly sums of money. Whereas people who have these, really, really high paying jobs, just kind of fade off or have to end up working for the rest of their life.
Yeah. A couple things stand out to me there. So first is, you mentioned an ideal life for you is like analyzing companies, managing your portfolio and keeping up with all those things. So, it's finding what you value in your life. And second, it's recognizing that while a lot of people, find value or believe that happiness for them lies in the next big purchase, the bigger house, the nicer car, or whatever else, it's recognizing that, hey, I don't have to allocate my money, or show that I value those things. I can use my money to buy freedom. And that's just a realization that I don't think many people believe is even an option for them. Like, money can be used as a tool to, unlock, buy back our time because our time is finite, and, have that freedom to chase things that you value most. For you, it's managing your portfolio, spending more time with your family, and generally just having like free time to explore other things as well. And it's funny looking back, when I go back to when I was in high school, considering what sort of career I wanted to pursue. One of the most important things for me, whether it was consciously or unconsciously, was having, pretty good income. And this wasn't because I wanted to become financially independent when I'm 35 or whatever else. Really, it was the lifestyle that income could give me, because I didn't realize that you could use money to buy freedom, because so few people, I think, talk about it or just sort of live that out in their lives. I think about a lot of my parents' friends that are doctors or dentists or whatever else. Like, they typically work like much of their lives into their 60s, just like a lot of other people. And you just don't really realize, like, growing up, that that's even an option. You can go and do other things. You can buy back freedom or work on things you really enjoy. And there's that saying that true wealth is measured in terms of personal liberty and freedom, or essentially the ability to control your time. And it reminds me that someone could have all the money in the world, but if you're selling your time, like 14 hours of your day, and then you're sleeping 8 hours, then you have like 1 or 2 hours to yourself to like cook, clean, do laundry, all that. And if you also have expenses that exceed your income, one has to question if that person is actually wealthy, even if they have the car, the house, whatnot. One of my favorite books on financial independence, it's J.L. Collins's book, The Simple Path to Wealth. And he explains why having, it's a general rule of thumb, 25 times annual expenses is enough to be considered financially independent and never work again. And he goes into way more detail in the book that I'd rather not cover here. So just for simplistic sake, say you're living in New York City, your expenses are, just say, $100,000 a year for your family. 25 times that is $2.5 million. So one might say that's a lot of money. Another person might say that's like much less than they think they would need for to be financially free. And to me, really, when I try and implement this into my own life, I see the holy grail not so much as hitting your number, but finding something that pays you a reasonable or decent income, but it's also something you've really enjoyed doing. And you see many people in the financial independence retire early community, they work jobs they like, they're making crazy good money, but they're thinking 5 or 10 years out. They just want to work this job they really don't like so they can hit their number, go to the beach, and live a totally different life. But everyone values something different, and everyone has to figure out, what it is they want their life to look like. And, I'm not really in a position to say what's right, what's wrong. You have to, look at your options and educate yourself on what opportunities are available. And Charlie Munger, I mentioned him. He was a huge fan of Benjamin Franklin, and he was well aware that it's not money that's scarce, it's our time that's scarce. And Franklin knew that once you're financially independent, you have the ability to buy back your time. And then he started doing things like giving back to society, just do things that he thought was beneficial for society and fulfilling to him. And he wrote about how he wanted to live a useful life rather than simply die rich. And it reminds me again of the story I mentioned at the start where, he just had a tremendous impact on society just because of the decisions he made and the contributions and, the investments he made in himself and understanding investing, compounding and such. And again, one of my favorite chapters or favorite books overall is The Joys of Compounding. And he has a chapter in that book on financial independence that I just loved. He tells the story of Munger going through some really tough periods early on in his life. He was broke, divorced, lost his kid when he was 29 and persevered through that. And ended up making just like an amazing life at the end. And I just really wanted to mention that chapter. And I wanted to transition here to talk about the ways we can achieve financial independence or hit that 25 times number that I mentioned. And that's also referred to as the 4% rule. I believe it's called the Trinity study they put together. And there's so much research out there online if anyone wants to dive in deeper on the 4% rule. But in terms of hitting our number, there's a number of ways to get there. There's plenty of asset classes, there's stocks, there's bonds, real estate. One could use their own business to build their wealth. Someone else's private business, invest in someone else's business, or, I mentioned stocks, which is just public equities. And then there's things like precious metals and Bitcoin, which Preston covers on the feed here. So instead of diving into the ins and outs of each asset class, how about, Kyle, you talk about why you're dedicating, the vast majority of your time and energy towards the stock market?
Yeah. So like you said, all those options are really good. But me personally, I have a very large percentage of my family's wealth in the stock market. And essentially the simple reason for that is that if you look at long-term charts, stocks are the best performing financial asset over like 150 years. But that's not everything. I think I've educated myself enough that I feel like I have the most amount of knowledge of businesses as compared to the other assets that you named on that list. So, things that I've learned about to understand stocks better are things like financial statements, moats, management, capital allocation, investor psychology, case studies of successes and failures. Biographies are a really good source, and just learning about business models in general. So all these areas that I've really just educated myself on because I'm passionate about it really, really support me investing in public companies. And if I had to go outside of the public company realms, the next bucket that would make the most sense for me based on what I know would be private businesses because, there's not much difference. It's just one has a stock price and one doesn't. So I've had some experience investing in crypto in the past, and I made a lot of mistakes. So I feel I proved to myself that that wasn't an arena that I had much proficiency in. And I know many others have succeeded, and my hat's off to them. But when it comes to figuring out what to allocate your own savings to, you should take into account what you're already good at. If you have spent, decades in the real estate market, but don't know the difference between a stock and a mutual fund, well, then you're probably better off investing in real estate. This is why investing is such an exciting endeavor, because there's multiple roads that lead to Rome. And you just have to find which road is optimized for you before you make the trek.
Yeah, you make a really good point on picking the game that we're equipped to win. And part of that is how we're wired. And part of it also is just the skills we've developed over time. Like some people are just sort of born into a real estate family where their parents have always invested in real estate. And that's what, they taught their kids. And same thing with the stock market. And I do know a number of people that are deeply involved in real estate, and that's the game they know. And I think that's generally kind of the sentiment with real estate is that you lose a lot of the control when you invest in stocks because you're outsourcing the management of the companies that you own when you buy stocks. Some see that as a benefit, others see that as a drawback. And, that to a large extent, that's true. Like, I don't want to manage all the companies I'm investing in. I want someone else to do it. And then you also might meet someone that's a day trader. And for whatever reason, that might just be the game that they're equipped to win. And that's okay. And it also just might be how they're wired. They don't want to just sit back and not look at their investments for the next year. So, and you might talk with a day trader and be like, hey, you could compound your money in whatever stock or index fund and watch it grow over 10 years. But they just want to focus on surviving that day. They love sort of that game, and that's the game they're equipped to win, and just the way they're wired. And again, that's just the way it is. And it's common advice in the world of the stock market, and what J.L. Collins talks about in his book is for the vast majority of people to just invest in an index fund or a basket of index funds and take the guesswork out of choosing individual stocks. And for the vast majority of people, I think they may get better results just buying an index rather than picking stocks. That's not only because of the returns, but also the time that must be invested in researching companies, doing the due diligence, keeping up with their quarterly earnings, looking at the company's competitors, the list goes on. And when you're buying an index fund, if you're not familiar, a couple of very common ones here in the US at least is Vanguard's S&P 500, the ticker's VOO, and the total stock market index fund is VTSAX, both very popular. And I believe they both have similar return prospects. And I mentioned the time that's needed to manage a portfolio. Kyle, you and I talk a lot about this, and we spend a lot of time on it with the community. My question is, when does someone really get a feel for picking individual companies is the game they're equipped to play and a game they're equipped to win? Because there's just so much more that goes into it when you're picking individual stocks, and you're super passionate about this, and you're quite certain that that's the path for you. So certainly you have some insights on, what we need to think through in deciding, individual stocks is something, a game that we should be playing. What if in 2024, you got a little bit better every day? When you're learning a new language with Babbel, that's exactly what you're doing. And if Babbel can help you start speaking a new language in just 3 weeks, imagine what you could do in a full year. Babbel's quick 10-minute lessons are designed by over 150 language experts to help you start speaking a new language in as little as 3 weeks. Babbel's tips and tools are approachable, accessible, rooted in real-life situations, and delivered with conversation-based teaching so you're ready to practice what you've learned in the real world. Thanks to Babbel, I can start having conversations and order my food in Spanish at local restaurants when the situation allows. It's no wonder they've sold over 10 million subscriptions, and that studies from Yale, Michigan State University, and others continue to prove that Babbel is better. Here's a special limited time deal for our listeners. Right now, get 55% off your Babbel subscription, but only for our listeners at babbel.com/WSB. Get 55% off at babbel.com/WSB. That's spelled BABBEL.com/WSB. Rules and restrictions may apply.
I get asked this a lot, and looking back at what I did, I probably took the incorrect path, which is fine. But for people who don't understand businesses or don't really understand stocks, you're probably better off, like you said. And what I suggest to people, if they ask me, is just buy an index fund first and then go from there. So I didn't take that route. I just went right into stocks. But the thing that's cool about index funds is it's very forgiving. You don't You don't need to know how to read a balance sheet. You don't need to know about financial statements. You don't even need to know the CEO's name or what the business sells. Because there's 500 companies in the S&P 500, there's no chance that you're going to have, you might have in-depth knowledge about a couple companies, and that's cool. But there's no way you're going to know a lot about all the companies in an index fund. So to me, if you have an index fund and you find yourself spending time learning about some of the businesses inside of that index fund, well, that might be a trigger that maybe stocks or maybe a portion of your portfolio might be invested in stocks. Again, not financial advice. This is just kind of what I kind of foresee. So like I previously mentioned, I love individual businesses. So for me, to make that synergize kind of with my investing strategy, it makes more sense to me just to own a few businesses that I feel I understand really well. Like I said, I can't understand 500 businesses. I can understand 10 to 15 businesses. So to me, that makes more sense to me. And I'm willing and able to put in the work to understand those businesses. But, it is a lengthy analysis period. Like I said, I could, if I was financially independent, I could manage my own portfolio, or I could just own an index fund and do absolutely nothing. But part of the joy for me of investing is I actually enjoy it. I enjoy spending my time doing it. So, that's just kind of a personal thing. But because the process is so lengthy, it requires a few things in order to make sure that you only have a few ideas. So, you have to make sure that you have conviction in your ideas and kind of know what you have. You have to understand that you are going to be spending a lot of time. It allows me, when I know only a few ideas, to put more money into certain ideas that I think will have really, really good returns, or certain ideas that I think I have a lot of conviction in. And then, it gives me the ability to leave a business if I don't think I like the direction that it's going in. And so because I've learned all these things, and I feel confident in using that as part of my strategy, it just makes more sense to own a few businesses and let the thesis that I find play out and see what happens. So, just getting into strategy a little bit more, I know that my thesis will be wrong at times. And when I'm wrong, I have to determine if my thesis can get back on track or not. Sometimes it can get back on, and sometimes it's permanently derailed. So if it is permanently derailed, that means I have to sell. And so, we'll be getting over some mistakes and stuff that people make. But for me, if I find something that isn't working out, then I just sell it and reallocate it to a different position. But the goal for me is to try and make it hard to find bad businesses or bad investments in my portfolio. I think that most people should go the way of index funds simply because you get that nice 8 to 10% return. And you literally you don't have to do any of the work that I just mentioned above, because, you can easily spend 40, 60, there's people probably spending 80 hours a week doing all this. I don't personally, because I have a life and a job and a family, but my goal is to hopefully get above those rates of return by utilizing my behavioral edge. And so, yeah, this is my journey, and looking forward to how it ends.
Yeah, and what's really interesting and somewhat puzzling to some people is the enjoyment of it. I think I know a lot of people who would be happy to manage their portfolio, and even if they knew their returns were going to be slightly lower than the index, they would probably still do it, because it's their way of interacting with the world and their way of learning more about that. So is that something you resonate with?
Absolutely. Yeah. I mean, ever since I started learning about investing, I learned all about all sorts of things that might not even have to do with investing, because, obviously I'm trying to learn, trying to be a generalist, right? So I'm learning, all sorts of things of different mental models, different sciences, psychology, all sorts of cool things. And 100% you nailed it. It really helps me understand the world better. It helps me keep up with things that I find important and interesting. And yeah, I agree. I think there's a lot of people that probably know that they'll underperform an index, but that little fee, that little change in return is worth it, just because they get to partake in investing in individual stocks.
Yeah, and I say the knowing they had underperformed kind of tongue in cheek, because we never really know what our returns are going to be, and we can always find reasons for why we underperformed in recent years and the mistakes we made, and hopefully we improve on those mistakes and get better over time. And investing, it's also a process of compounding knowledge. Um, I'm reminded of the Buffett quote that he's a better businessman because he's an investor. He's a better investor because he's a businessman. And I feel that that's definitely applied to my life as well in thinking about business in general and what we do here at TIP. And I think that feedback also goes back to being an investor. And I think of companies like Costco and the tremendous value they're adding to society. Like, I know it's not a company I'd ever own, but like learning about that company is like so cool to me. And like the tremendous value they're adding to society, like why no one else can do what they do, what's their edge in the markets. And just like studying all these things is so fascinating. And it's just a rabbit hole that feels like it really never ends.
Absolutely. And I agree with you on Costco. I've spent some time researching them and learning about sold price. And yeah, it's an incredible case study and definitely worth it just to understand business better.
So again, one of the things I think people have trouble with, we see this a lot in our community, is the time commitment that it takes for managing a portfolio. So say someone wants to own 15 or 20 companies, they might end up analyzing 40 names, and it takes quite a bit of time to dive into a name, read their reports, listen to some of their earnings calls, and all the research that goes into that. And a year or two ago, you wrote an ebook. It was called 5 Minutes to Know, and it explains how you quickly say no to new ideas. And Stig always says to me that saying no is the best productivity hack, and it's really good advice with all the things that can grab our attention nowadays. And I think before you go out and pick stocks, you need to figure out what you're looking for. Ian Castle mentioned it just to me on the show that everyone, when they first start out, it's like they show up to a restaurant the first time of their lives and you don't know what you want. You see the menu and you just start trying things. And oftentimes people do the same thing in the stock market. They see Apple in the headlines, they go buy Apple. They shop on Amazon, so they go buy Amazon stock. And it's pretty well in line with Peter Lynch's advice of getting exposure to the market is just buying companies you interact with in your day-to-day life. So talk more about some of the things you covered in your ebook, 5 Minutes to Know, and how we can quickly figure out what we're looking for and filter out the rest.
Yeah, great point. I mean, when I first started investing, I remember making I still have these, Google spreadsheets of like 100 businesses, and I'd be looking in them, and I don't think I bought any of them. And I literally spent all this time making that list, and it was a waste of time, right? So as I've gotten more and more experience, I've realized, okay, well, I want to have a system where I could, not do that, and hopefully spend most of my time finding ideas that I actually want to invest in and make sense for me and my financial goals. So I wrote the book specifically because I wanted to refine my own system, and I thought it was pretty repeatable so that other people could hopefully use it as well. It's super simple in my opinion, but basically it allows you to easily find out if a business has some degree of quality and also finding the growth that I seek personally. So the beauty of the system is that you can pick and choose to have numbers to whatever specifications you want. I'm trying to find investments that are, growing at pretty high rates, hopefully around 15%. And that's kind of what I want my returns to be as well. So I have numbers optimized specifically for finding that kind of investment. So, other people might have different things they're optimizing for. Maybe they want 10%, maybe they want dividends. And that's cool. And you can, kind of pick and choose and change it however you want. But this was kind of my system. So the way I do it, I literally just, I go over in the book, but I can literally just put a ticker symbol in FinChat and just, I click a couple buttons of things that I think are interesting. And then it gives me those numbers in compound annual growth rates. So I might do things like checking revenues, net income, earnings per share, the shares outstanding, checking their debt, checking cash flows. I can see the capital efficiency. And I can see all this just on FinChat. So it takes me really, really short period of time. And then there's other sources you can check to see insider ownership, as I do like having pretty high insider ownership. And it basically just lets me see really quickly if a business meets the benchmarks that I'm looking for. And, will it remove a lot of great investments? I know I've gotten a lot of flack on X from people being like, oh, well, like you would never have found Amazon. And yeah, for sure. It definitely removes tons of good investments. But the point of it is it just adds an additional guardrail and simplifies things. So, now that I understand the system really well, I can easily make modifications to the system that work for me. And I break my own rules all the time because I understand it, and I know what I'm looking for. And there might be certain situations that might not necessarily fit right away, but I feel like at its ground base, the system still kind of runs what I'm trying to do. It's just like I said, there's a lot of little nuance to how I use it.
You mentioned all those metrics, revenue, net income, all these financial metrics. And one really important one is return on invested capital. And you wrote about that in the ebook as well. I think a lot of retail investors don't really understand what this means. And it's actually one of the most important metrics to know. And I've been recently reading the book you covered on the show, What I Learned About Investing from Darwin by Pulak Prasad. And man, it is definitely one of the best investing books I've read in the past year or two. So Prasad, he uses return on capital employed instead of return on invested capital. And that's his most important metric for filtering on business quality, because really it takes into account the profits that a company produces, as well as the amount of capital it took to produce that level of profit. And when you filter on this, it's quite interesting because you obviously narrow down your opportunity set of the companies you're looking at, and then you have a good number of high quality businesses once you filter on, say, 15% return on capital employed, for example. But when you don't filter on that, of course, you might be filtering out Amazon or Netflix. And he makes such the great point that, just considering like the base rates of success, there's a host of tech companies in 1999, and obviously Amazon was the right one to invest in, but what's not in the headlines is the countless others who maybe had a leader just as brilliant as Jeff Bezos, but, things just didn't work out the way it did with Amazon. And, again, the base rates of success, it's something that's really important. And, one thing that I've been thinking a lot about lately in reading this book is just minimizing the chance of luck playing a role in investment success. Obviously there's luck plays some role in a lot of companies, but you want to try and minimize that and, maximize. I always think back to my interview with Morgan Housel. He tied in a quote from Naval where Naval is like, if you lived 1,000 lives, you want to make sure you're wealthy in 999 of them. And, there's plenty of alternative histories out there where maybe Amazon doesn't do quite near as well as they did. Or maybe there's a scenario where, the retail business does well, the stock is average at best, but Amazon AWS was never a thing. Just simple, things like that. Luck certainly plays a role. And again, we're not here to say there's a right or wrong way to invest, but what we can do is share how we sort of think about things. So turning back to return on capital employed here, it's calculated simply as the operating profit of a business, or the EBIT, divided by the total capital employed. And the total capital employed is simply the total assets minus total liabilities. So again, how much profit does a company produce relative to the amount of capital it took to produce those profits? So it's really bringing in two financial metrics into one. And then since we mentioned Costco, I pulled their numbers. Their return on capital employed is around 23%. And you'll find that most other retailers have a much slower return on capital employed. And that's also why Costco trades at a higher valuation relative to their earnings. So really, if you put $1 into Costco, it's really a metric of how much earnings would that dollar give you back. So if you put $1 in and they go out and reinvest it back into the business, you'll get 23 cents in profits. And Prasad, I just love the way he explained why this metric is so useful. We're told to look for so many things when selecting businesses. And he talks about how just this one thing is such a great filter for filtering on quality. And, many businesses have managers that are impressive. They create amazing products. They're very charismatic. But that doesn't mean they're great capital allocators or the business has great economics. And he explains that many companies look to have great managers, but they either overlook or don't understand capital allocation. And it's sort of just a filter. Like instead of looking at a company and looking at the management, before you dive in deeper into the company, what's the return on capital employed? Because a high return on capital employed tells you that management's doing something right. So a consistently high return on capital employed, say it's greater than 15%, it's also an indicator of a strong moat. And it's just a really great starting point for what sort of return you can expect going forward. And of course, it's not a magic bullet, like just because you filter on this one metric, it's just like the secret that no one's talking about. But it tends to be a good place to start in your analysis. And I wanted to also mention a point that Prasad made I hadn't considered too much. He explained that a high return on capital employed business, it allows a company to take business risk without taking financial risk. So it really increases the chances of business success as they weather through this very intense capitalistic world. And companies with a high return on capital employed and a strong balance sheet, they can go out and invest in new opportunities and afford for them not to work out because they're in a strong financial position. Whereas if you have another business, they have low returns on capital, weaker balance sheet, and if that project fails, really could hurt the business because it could weaken their position. They need to issue equity, issue debt just to weather through that. And this is why you find in some industries that some 1, 2, or 3 players just sort of dominate, and then just the weak continues to get weaker, and you just see that divide in terms of the great businesses and the poor businesses. So again, such an amazing book.
Yeah, it truly was. I agree with you. Probably one of the best books I've read in the last couple of years. So Pulak did a great job, like you already outlined, about why he likes returns on capital employed and why it brings so many additional benefits to a business that has a number like a ROCE over, say, 15%. So I personally use ROIC, which has many similarities, but honestly, if you have a high ROCE business, there's a pretty good chance it also has a high ROIC. So, you're just kind of nitpicking here. But just kind of digging in a little more into the weeds, if you do decide to use these numbers, I would highly recommend kind of breaking them down and finding out, which numbers belong in there and which don't. So, so for instance, with returns on capital employed, you're using earnings before interest and taxes. With returns on invested capital, you're using net operating profit after taxes. So these are just minor differences. The numbers are going to be a little bit different. But if you look at each line item and that you're accounting for using those equations, you can take a look and maybe make a more accurate number by making certain adjustments. So an example here might be like for me, when I'm looking at returns on invested capital, I remove cash from the invested capital equation. So the reasoning for me is that cash isn't invested in the business, so it's not generating a return. So removing it makes sense. But, and this gets into really understanding a business. There are some businesses where they use their cash as in their business to operate it. So in that sense, you would actually keep a little bit of cash maybe in that invested capital number to get a more accurate return on invested capital number. So this is just saying that, look more into how you're doing these calculations, such as return on capital employed or return on invested capital. And look at the adjustments that can and should be made to make a more accurate number, because there's a lot of data out there, and you can make some really, really big blunders by just kind of defaulting and putting every company into one bucket. So just a resource I would highly recommend, just look up Michael Mobison's papers on return on invested capital. They're like incredibly well done. I've learned so much from them. So just look at that if you really want to get into the weeds. If you want to keep things super simple, just stick with whatever you learn on the data aggregators. But if you want to really understand a company really well, I would highly recommend digging into the weeds.
Another point that comes to mind here is the reinvestment rate. I'm reminded of Dino Polska because the formula just seems so simple, and we did an episode on it, so many in the audience are going to be aware as well. So if their return on invested capital is in the 20 to 25% range, and they're reinvesting 100% of cash flows, do you sort of assume that that's going to imply to, that level of earnings growth in the future? And maybe talk more about that reinvestment rate, because you might have a company with a high return on capital employed, but their reinvestment rate might be zero. So talk more about that sort of dynamic of how that ends up playing into how the business develops and maybe its stock performance too.
Yeah, absolutely. You nailed it there. I mean, I think IBM, and granted, I don't follow IBM very closely, but I believe IBM has a pretty high return on invested capital. But if you look at its share price, the changes in it, it's not very good. It doesn't come close to tracking how successful IBM should be, given its high return on invested capital or high return on capital employed. But and the reason for that, like you pointed out, is reinvestment rate. So a lot of these businesses, they can't reinvest their money. Basically, the business is as is. They're making all sorts of profits and cash flows, which is great, but there's nowhere for them to put it back into the business. So in that case, they kind of really only have two things they can do. They can pay a dividend, or they can buy back shares. So, but if you look at if you read 100 to 1 in the Stock Market by Thomas Phelps, he had some really good examples using Tampax, and he showed how he talks about how dividends are an expensive luxury. So, if you pay a dividend, essentially you're reinvesting less money back into the business. So even if you have that high return on invested capital number, you're not going to be getting 100% of that number. You're going to be getting a percentage of it. So I'm trying not to get too mathematical here because it's not really easy to explain those terms over a podcast. But essentially, if you want, capital gains, such as like what Dino Polska, I think, offers, you want a business that has high returns on invested capital and the high reinvestment rate. So another business that a lot of listeners are probably familiar with, because Stiggs interviewed the CXO, Daniel, a few times, is Technion. So they're another business that they had a small dividend, but now they've gotten away with that. So they're reinvesting 100% of their profits, and they also have high capital efficiency metrics. So that means that, they're reinvesting every dollar they make back into the business, and they have a very good history of making really good investments. So that's a business, along with Dino Polska, that I'm very familiar with and very happy to hold for a long period of time. But so it also kind of comes into the life cycle of businesses. More mature businesses, they run out of places to spend money, whereas a younger business might have a bunch of different places to spend their money. So you kind of have to be the judge of where a business is in its life cycle and understand it really well. And then the other thing also to look into is that, with Dino Polska, they're reinvesting all their money into one thing, which is just new stores. And they have a long track record of doing that really, really well. Whereas some other, like look at Google, they have a whole other bets part to their balance sheet of other bets that they put money into. And a lot of them, probably worth zero. But, they have their own way of doing it. It's kind of like the Amazon model, where they're just throwing some little things at the wall, not spending a lot of money and hoping one works. So in Amazon's case, Amazon Web Services worked well. But there's just something to be said with, if you have a business that can clearly reinvest its money into something that it's already really, really good in, that's where the magic comes from. So that's why Dino Polska, in my view, is priced where it is. It's just an incredible business. They can keep reinvesting their profits for quite a long period of time, and they probably are still going to earn the same returns on invested capital. So yeah, I hope that's helpful.
Yeah. And another thing that you mentioned there that's really interesting is each company has its own life cycle. So when a company's in its first few years of operations, they found their niche, they found what they can do differently and what sort of value they can provide. They have a small part of a large market generally. And, in a case where they found a formula that works and they have something they could copy and paste time and time again. I'm reminded, I just picked up William's book this morning, and I was reading through Will Danoff, I believe his name was. He was at Fidelity, and he has a very, very good track record. He interviewed Howard Schultz 1 week before they went public, Starbucks, and they had, I believe it was 192 stores. And Will Danoff saw that it costed $250,000 to build a Starbucks location. And then in year 3, that store would earn $150,000 in profits. So that's a 60% return in year 3. And then hopefully that's, stable over time and competitors don't come in and eat their lunch. But 192 stores, and, there's hundreds of thousands, if not millions of coffee shops globally that they could, try and steal some share from. And that's a case where it's very early on in 1992 is the year it was when they went public. And I think for you and me, we want to find companies that are earlier on in their cycle. There's enough history to where we can see the formula works. It's predictable. We have a sense of management knowing what they're doing and the market opportunity that's there. But say, there's someone that's listening to the show and they have a nest egg that they need to protect and they're in their 60s or 70s or whatnot, then they might want companies that are later in their life cycle where they can start collecting dividends from companies and they don't need a lot of growth. And obviously there's execution risk in terms of going and continuing to build and expand the business. So I think there's sort of an alignment of, as an investor matures and ages, the companies they're looking for changes as well. And that's totally okay. And obviously there is some execution risk with a company like Dino Polska. Over time, we're hoping eventually they have double the size of their business, and that's not going to be easy. I don't care who you are. And Technion as well. They're going to have to learn a lot of new things and growing and expanding their operations. And yeah.
Yep, totally. And that's perfectly fine. You don't have to. If you're someone who's averse to risk or is someone who's going to be in need of your money in a very short period of time, well, then your investing strategy is going to be a lot different probably than Clay and I, because we still have probably decades until we're going to use our money. So, yeah, and that's perfectly fine. You don't have to get into everything. You may definitely make sure you know where you are in your life cycle and how soon you're going to need the money, because if you need the money really soon, then it might make sense to have a large proportion of your investments in bonds, because they tend to be very reliable and don't go down very much. But not something that interests me.
What's also interesting with regards to stocks is so many people talk about the statistics that show that it's very unlikely that a retail investor is going to beat the market. And obviously, I'm somewhat biased because I'm a stock picker, just like you. And maybe I'm way overconfident in my abilities to do well in the markets, but I'm led to believe that individual investors actually have some edges that either institutions or other market participants just generally don't have. And I'm going to highlight a few edges here just to share some of the things I've found in the research on, why should I be picking stocks? Why not just park it in an index and just call it a day? So the first one I wanted to mention here is that I think the biggest edge that individual investors can harness is patience. It sounds so simple that it just can't be true. But I truly believe it's the case. And Bill Miller, he's well known for saying that there are 3 edges an investor can have. That's informational, analytical, and behavioral. So in terms of information, everyone nowadays has access to the company's filings, and the internet made that accessible to everyone. So Ben Graham might be able to have a informational edge, but I don't think I'm going to ever have one. The second one is analytical. So I don't believe I necessarily have an analytical edge. There's a lot of people out there that are a lot smarter than me, and a lot of people that build complex programs that I'll never be able to understand. So that leaves us with behavioral. So there's plenty of data out there that shows that the average holding period of stocks continues to decline. One of the more recent studies is in the 1970s, the average holding period was 5 years. And in 2023, it was just 10 months. So the average participant is holding a stock for 10 months. And I generally think that humans are really just biologically hardwired to be impatient. And it makes sense if you're out in the African savannah, like you don't care about the compounding that can happen 10 or 20 years down the line. You're just wanting to figure out where your next meal is going to come from. And I'm led to believe that most market participants aren't willing to look out 5 years or more in holding a great business that might have a PE that's optically high. So I'm also happy to see Meta stock recently cross $450. And that's not because I own shares, but I think it's a perfect example of the market largely being inefficient. So in less than 18 months, this stock is up over 400%. And I'm nearly 100% confident that the fundamentals of this business have not changed by that much in that short period of time. And then the second point I wanted to mention here is Gautam Bates' book. It just really influenced me and led me to believe that quality companies have the potential to be underappreciated by the market. And the best businesses tend to have earning surprises to the upside. It's quite funny where as value investors, we're sort of taught to have like conservative assumptions, and that can keep a lot of people out of quality businesses because they're conservatively doing 10% growth rates for 3 years and maybe not really willing to look out further, when in reality, the business has consistently grown at over 20% a year, and you just never buy it because you don't realize the quality that's there. And then investors also just underestimate the duration of how long a quality business can grow. So the difficult part with this is that it takes time to realize whether you were right in your initial assessment. So you might buy a business today in 2024. The stock price might not go anywhere for a few years, and maybe the business continues to execute. But it just takes time to recognize whether you made a mistake or whether you were right in your assessment. So that's really the difficult part with thinking long term and being patient. Is it might take years to recognize whether you're any good at it or not. And the third point I wanted to mention here is not every business is as well covered as every other business. So many people pay close attention to the Magnificent Seven, but there are loads of quality businesses out there that 99.9% of investors have never heard of and don't even know it exists. And this really can create significant mispricings. And it's funny, I mentioned the informational edge earlier, how, information's available to everyone. That still doesn't mean everyone's looked at every single business out there. And there's a lot of great businesses we've found and talked about in the community, Kyle, that, there's zero analyst coverage. No institutions have even looked at it or invested. And, you and I have talked a lot about how we're finding opportunities internationally, outside the US at least. And there's still great opportunities in the US, but there seems to be even more compelling opportunities for us, in our view at least, when looking at these other markets on a risk-adjusted basis. So it'll take time to find out if we're right, or if the US is still a better place to look. And another example is smaller companies tend to be more illiquid, and just because there's so few market participants that move the price, that can also create mispricings, and it also keeps a lot of institutions out from even investing in it, or again, even looking at it. So yeah, international companies can, create inefficiencies just because the company's based outside the US. That means it might be more attractively priced just because less investors are looking at it. And then again, the size also plays in too. So with that said, the beauty of index funds is that it still takes all the worry of even having to consider all these factors of company size, the country it's in, and whatnot. And index funds allow anyone to harness the power of compounding, and you don't need to understand balance sheets and return on capital employed. So again, like you mentioned, you can know next to nothing and still be able to harness it.
Yeah. So I really think you nailed it with the 3 buckets on the edges that investors can have that were outlined by Bill Miller. So you had a recent interview with Scott Phillips of Templeton and Phillips Capital Management. And Scott was talking about these edges. And he said, quote, "Am I going to go out and compete with a multi-billion-dollar hedge fund that has satellite imagery and unstructured data to get the edge on customer accounts at shopping malls in Walmart or oil fields or cargo? You get the idea," unquote. So retail investor with limited resources there's just no chance you're going to be able to compete with a $1 billion hedge fund that has access to these types of information and analytical edges. But like you said, the behavioral department is where the individual investor really, really does have an edge. So I've written about this. I call it the retail investor's edge. And so I just wanted to share some key findings from when I wrote about it. So the first thing is if you put yourself in the shoes of a professional investor, you have to understand there's a whole bunch of different things that you have to worry about. Whereas when you're an individual investor, you don't have to worry about it. You have to worry about your partners. You have to keep them happy. And so this usually means that you're trying to basically match the index each quarter, so that you can have similar results to other managements out there. So I personally don't care about that. I don't care. So I might underperform sometimes. I might outperform. It might be the same. I don't care. I'm looking out, like Clay's been mentioning a lot, is we're looking out 10, 20, 30 years. So what happens in one quarter is completely irrelevant to me. So when you look at being an individual investor, you don't have partners, and it opens up a lot of strategies that institutions just simply can't do. So I'll just list off a whole bunch of them here. So like I just said, you don't have to track your performance on short-term fluctuations of stock prices. Prices go up and down, and a lot of times when they go down, I see it as an opportunity, whereas an institution might see that as I need to sell it. You can look at the process. So, your process is more important than your outcome. So whereas an institution might have to be worried about that outcome, I don't. I can just make sure I have a process where over the long term, hopefully my outcome is going to be very, very good. And so I'm okay with short-term losses, as I mentioned as well. So another one is that, you can use longer time frames to make great investments. So maybe a company is going through some short-term headwinds, but let's say in the next year, they're going to be out of those headwinds. You can buy these stocks, but if Wall Street thinks the stock price isn't going to move, they're not going to buy it. They're going to probably wait. So that gives the individual investor these huge advantages where it's like, okay, well, I'm going to buy the stock that's gone down. Let's say it's gone down 50%. Maybe it goes down a little bit more, but I'm going to hold it for 5 years. Whereas an institution might be like, okay, well, it's at 50%, it's cheap, but it could go down another 10% this quarter and, not provide any return for our partners. So they'll skip it. So another one is that you don't need to try to time the market. Institutions, like I said, they want to try to match the market. And so if they think the market's going to go down, they're probably going to sell, which is, it's not the right way to invest as we talk about all the time. And if you read all the greats, that's not what you want to be doing. So, we as individual investors don't have to fear short-term losses. And you should in fact live with them, because if you're a long-term investor, you should understand that sometimes the market won't love your stock and the price will go down. And as long as the fundamentals of your business are improving as you kind of envisioned, then you're good just holding on to it regardless of what happens with the stock price. Another one is that you can buy anything in any industry or geography. So Clay already brought this up that, we both look a lot outside of the United States. I still think the United States is probably the best market in the world, but everyone knows that it's the best market in the world, right? So that means that there's a lot of investors looking at companies in the US, and because of that, the prices are simply high. Whereas if you look at other markets, there's just prices that are not so high and a lot of very attractive opportunities and high quality businesses. And then, it also matters the geography you're looking at. There might be even whole countries that are unloved or that people don't understand. So, like Turkey, I know obviously Monish Pabrai loves turkey. I personally don't understand turkey at all, so I wouldn't invest in it. But if you have proficiency in other countries that other people don't, that's a huge edge that you can have. Another edge that individual investors have that Clay also mentioned was market cap size. So, let's say you're managing $1 billion. Are you going to buy a little nano cap that's $20 million and has a $1 million float? That's not going to move the needle for you. So you're not going to spend a second even thinking about investing in that business. And that's even not nano caps, even a small cap that's like $500 million. You're probably still not going to spend much time on that. So because of that, there's not a lot of professional investors looking at a lot of these businesses that are smaller, and a lot of them are really high quality. And that's a huge, huge, huge advantage, especially when you're an individual investor with, obviously, you probably don't have $100 million to invest. You might just have a couple $100,000 or $1,000, whatever. In that case, you can literally buy anything, and that will move the needle for you. So you don't have to worry about that, and you don't have to worry about liquidity as well. Another thing that individual investors can do is concentrate positions based on their conviction. So a lot of institutional investors have all sorts of restrictions that, like, for instance, the SEC will say, you can't put more than, 5% into a position. So for me, I have positions like Evolution that are 20%, and I have no problem with that. I sleep very, very well at night. But that's an advantage for me because I think that it's a position I have a lot of conviction in, and that's something that institutions can't do, because if that were to go down a lot, they'd get in a lot of trouble with their partners, but they'd also get in trouble with the SEC. And then lastly is that obviously as an individual investor, we can live with a lot of volatility. I kind of already hammered that point home, but just because your portfolio is down doesn't necessarily even mean you're a bad investor. This kind of goes into the process over outcome thing. You can have the best process in the world, and sometimes over the short term, the outcome won't be what you want it to be. But if your process is really good over the long term, your outcome should be really good. And so you can take advantage of that by just kind of shrugging off some of the short term losses that your portfolio makes, as long as you understand the businesses that you have in them.
I have a few points I'd like to add here. So I was on a call with a new member of our mastermind community, and he manages a family office. And he mentioned one of the key advantages I asked him if he managed, other people's money, friends or any other partners. And he said, no, it's just the family's money. And he mentioned one of the advantages of that is permanent capital. And it reminds me of Bill Miller. And I don't know the exact numbers, but the great financial crisis was a very, very tough time for him. And part of the reason for that was not only was his portfolio dropping like crazy because he had a heavy allocation to Amazon and the overall market was just getting hammered, but the investors were just pulling their money out of the fund at the exact wrong time. So, at the end of the day, he really couldn't control it. Obviously, he let them invest in the first place, and Nick Sleep has talked about being careful who you partner with and ensure. I think Sleep had people sign off that they should be investing for at least the next 5 years. And it's quite an interesting dynamic because you and I, Kyle, like when our portfolios go down, no one's calling us trying to get us to sell our positions. As we earn income from what we do, hopefully we're taking some of those free cash flows and buying better bargains when they're at great prices. And I was on a call with Chris Mayer for an interview the other day, and he mentioned to me that his fund's closed. And he's mentioned multiple times that when his portfolio goes down, he has a lot of investors calling him, adding money so he can go and buy. That's sort of the ideal situation for a fund manager. And it also creates a sort of paradox where if you're a really, really good investment manager and you have a track record of outperforming, naturally, just due to incentives, like naturally you're going to bring on more investors and your fund's going to grow. It's going to grow from 10 million to 100 million to likely much larger as long as you continue to do really, really well. And size becomes sort of a disadvantage where Chris, for example, is invested in a company that's sub $1 billion. And once he gets to a certain size, companies with less than $1 billion, he just can't really touch, either just due to liquidity issues or it just isn't going to move the needle. It might be, even if he makes it a 1% position, it's just not really going to be worth the time for him and in the way he manages a fund. So there's all these interesting aspects at play of how these incentives within how people manage funds and how that the downstream effects of bargains, where those bargains are to be found. And again, once you're aware of all these inefficiencies of how money sort of flows within different capital markets, you and I have a chance to hopefully capitalize on those.
Absolutely. And there's so much to do with how institutional money works that I've been learning a lot now. And it's a really interesting realm to try to educate yourself on.
Before we wrap it up here, Kyle, I know you've read a ton of investing books. And I know there's a lot of people in our audience who are readers and they're always looking for new books to read. And you found one that's probably going to be one of the best reads for me this year, What I Learned About Investing from Darwin by Pulak Prasad. So maybe you can mention a few of some of the most impactful books that helped you develop as an investor and maybe one or two of the high level takeaways, what you learned from reading them.
Yeah, absolutely. So the first one is probably one that's going to be a surprise to a lot of people, and that's Invested by Phil and Danielle Town. And the reason I think this book is so good, if you've been investing for 10 years, yeah, probably it's not the best. But as an introduction to investing, it's hard to find a book, I think, that's better, just because it does such a good job of making investing really, really simple and kind of covering the whole gamut of what you need to know in a very simplified way. So I personally, it's funny because he has a couple of valuation methods that he uses to evaluate businesses, and I still use them to this day. They're all really simple, and I love simplicity. So that was probably one of my biggest takeaways is his evaluation methods. And then, he talks a lot about moats and just simplifying what they are, what they mean, and labeling them, which was really helpful. So if you're a lot newer to investing, I think Invest is a great book. I'm lucky. That was honestly, I think it was like maybe the second or third book I read about investing back in 2020 when I really started getting interested. And I still refer to it because it has some really, really good points and it's really simple. So highly recommend that, especially if you're newer. Then probably the one that has the most impact on me was The Most Important Thing by Howard Marks. There's a lot of things that I learned from this, but I really, really think it's probably the best book on risk in relation to investing that I've read. He does such a good job of showing you, how market cycles work and where risk is off and where risk is on inside of that market cycle. And it's really, really important, I think, to understand that. One thing I really like to do is when the markets are up and everyone's euphoric, and maybe me too, I'm happy, is I'll go back and look at risk and read about, he talks about things that happened in the great financial crisis and the tech bubble, just to kind of get a reminder that, when everyone's really, really happy is the time when you actually should start being kind of scared, because that usually means that the cycle is going to turn. Who knows when? Again, he makes a really, really good point that you shouldn't be trying to time the cycles, but you should understand where you are in them. So I think that was really important. And then another book that had a really big impact on me was The Warren Buffett Portfolio by Robert Hagstrom. That one, man, like I learned a lot about how I invest now, which was, things to do with conviction, concentrating your portfolio, being long-term oriented. He uses tons and tons of different case studies from, investors that everyone knows, such as Warren Buffett, of course, and Charlie Munger, John Maynard Keynes, and all sorts of just really concentrated investors who had these really good track records, and talks about the similarities in their strategies and how it works. And another thing also that I really liked was that he talked about being long-term oriented in that book, and especially how if you're long-term oriented, you don't necessarily have to look at the stock prices to determine how good you're doing. So he talks a little bit about Buffett and look-through earnings, and how, Buffett, I don't think he's talked about it for quite a long time, but he has in previous letters. And, that's a really good way of just measuring your performance without even necessarily having a ticker price. So, you just, for instance, you can add up the EPS of the businesses that you have and look at how that goes up over time. And, that's just a really easy way. Cause if your businesses are all growing at 15% per year, then generally speaking, your portfolio should probably grow at about 15%. Obviously it won't, because the stock market is fickle, and over the short term, it likes things and it hates other things. But the point being that, if you want to be long-term oriented, using metrics that maybe don't have to do with stock price are a really smart idea to track your own performance. So yeah, those are 3 books that definitely had a lot of impact on me. Obviously we could spend a lot of time digging into specific things in there, but yeah, those were the 3 for me.
All right. I'll be sure to get all 3 of those linked in the show notes. I'll also add a couple comments on the invested one. For anyone in the audience that's like pretty new to investing, or they don't really know where to start, I think one of the most important things is to just like find the right resources to help get you going, because so much of the learning comes in that early part of the phase. And now, Kyle, when you and I read an investing book, like, we're just happy to get like just a few insights we sort of add to our investing toolkit. But initially it's just like information overload. And, when you find the right book, it can just be immensely, immensely helpful. So I'm glad you mentioned Invested by Phil and Danielle Town. And then regarding the Warren Buffett portfolio, you talked about look through earnings and looking at the business performance rather than the stock performance. And I'm reminded of 2022. I just chatted about this with Chris Mayer, where that was a year where many great businesses, it was really just business as usual. They continue to increase earnings. They continue to reinvest. They continue to do what they've always done. But there's so much noise. Markets overall went down. So a lot of these share prices went down. But I'm also reminded of Chris Mayer's book, 100 Baggers. If you look at Monster Beverage, if you just look at their financials and that's all you knew about the business, you probably never would have sold that stock, because earnings just went up year after year after year. And any of the noise you took in would have just been detrimental to potentially trimming your position or selling when the share price is down and such. But I don't want to keep you too long here, Kyle. Really appreciate you joining me. And that wraps up our discussion on stock market basics and financial independence. And we're actually going to be releasing a second episode here in a couple days on Saturday, March 9th. We're going to be talking about what we've learned about investing in stocks over the years and some of the mistakes we've made. And hopefully we can share some of those mistakes and you can learn from them and not make the same mistakes we did. So be sure to follow the show and get notified of our episodes next released. And Kyle, thanks so much for recording with me. It's always a pleasure to have a chance to connect on the show.
Had a blast.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
I'm not sure I've seen a portfolio with this many multi-baggers in one place. I thoroughly enjoyed learning all the lessons he took from Darwin and biology and how he's applied them to investing. His 3-step strategy is both simple and repeatable. 1, eliminate significant risks. 2, invest only in stellar businesses at fair prices. And 3, own them forever.